high, much higher. And of course, when you add in insurance and taxes and maintenance costs, the home prices are just unaffordable. So that's where you're seeing a lot of pressure, downward pressure on the economy, downward pressure on prices, because the natural gravitational forces are for prices to fall. That's the natural state of thing, the state of affairs. It takes a lot of monetary fuel pushing into the market to keep these prices afloat. But if the bank lending isn't there and the consumer doesn't want to borrow and corporations are saturated in debt, and they are, then I don't think you're going to have much of a mollifying effect from a handful of rate cuts that are going to happen between now and, say, the middle of 25.
As the global economy navigates turbulent waters, gold is emerging as a safe haven for investors. With rising concerns over inflation and potential economic downturns, the precious metal has recently surged past $2,500, reaching new all-time highs. Michael Pento of Pento Portfolio Strategies emphasizes that gold thrives in environments where real interest rates are negative and nominal rates are declining. This is precisely the scenario we find ourselves in, with the Federal Reserve hinting at potential rate cuts to manage a slowing economy. While gold is gaining favor, silver's outlook remains more ambiguous. Pento notes that silver, which carries both industrial and monetary components, performs best in a globally reflationary environment, one that is currently absent. The global economy's lack of momentum and the absence of significant industrial demand leave silver in a more precarious position compared to its glittering counterpart. The broader economic landscape is fraught with risk, as Pento highlights the existence of three concurrent bubbles in housing, equities, and bonds. These bubbles, now larger than any seen in previous economic cycles, pose a significant threat to financial stability. Despite some disinflationary trends, inflation continues to erode the purchasing power of the middle and lower classes, with essential goods remaining unaffordable for many. Now we'll show you the best clips of the latest interview, but first, smash the subscribe button, hit the like button, and turn on notifications so you do not miss out our daily recaps.
Gold loves negative real interest rates and falling nominal interest rates. That's exactly where we are. So what gold hates, what gold gets killed in, that's the environment, is what I would call sector 4 of my portfolio. The sectors go from deflation, disinflation, stasis, reflation, and then stagflation or hyperinflation. Sector 4 is when you have a relatively healthy economy in the context of rising nominal rates, which happens in reflation. Well, we don't have that now. What we have is the Federal Reserve, who is telling you that, hey, we're ready to start cutting interest rates. Here we go. We're going to start cutting rates. We're going to be cutting rates for the next year or two. We're going to take them down to around 3%, from 5.25% to 5.33%. Effective Fed funds rate is 5.3%. And that's the direction of travel for interest rates. So nominal rates are going to be falling. And if they're falling in a context where we don't have deflation, because remember, gold does not like liquidity crises or a sharp deflation. Gold really likes disinflation. So I always start with 5% physical gold in your possession, and then you toggle your investment portfolio of what I call liquid paper gold between 0 and 20. We are at 10% right now in that very liquid, I call it, like I said, liquid paper gold. So think of that like either ETFs or even the gold miners. But in an environment where you're headed into possibly disinflation to deflation, you should be very wary of miners, because miners are stocks, and stocks usually get killed in deflation. So just be careful of that. Me personally, I like silver when we have a global reflation occurring, and I just don't see that right now. So you want to see the global economy starting to boom. So this, because silver has an industrial component and a monetary component. So you want to see global growth accelerate. So demand for silver would be strong. in the context of some reflation. I don't see that right now. I just don't see it. And remember what I said. The Fed can control short-term interest rates. They don't control long-term interest rates. And if you look at the fact that we've had real positive Fed funds rate now for well over 12 months, so it's well over a year, and they're positive by 2% plus, that seems to be that's when you see that's when historically things get really ugly in the money markets and in the economy. So I'm monitoring the situation. The odds are very high for a very chaotic period to occur. The time is just not. It's just not yet.
In today's news recap, silver price retests $30, setting the stage for further gains. Silver price hit the $30 per ounce mark for the second time in as many days, having edged up plus 0.5% in early trading on Tuesday. Also, the grayish metal extended its winning streak to the third session in a row, within a longer uptrend that goes back to early August. Silver price has renewed propulsion from the geopolitical tension in the Middle East in the last week. Silver price is also driven by the impending Federal Reserve interest rate cuts starting September, which has driven up safe haven demand for non-yielding precious metals. Silver price has gained 2% in the last 5 sessions and is up 7.9% in the last month. That has built a strong bullish undercurrent that could sustain further gains. A return to the $30 territory is significant, as it creates the psychological foundation to sustain the recent gains. With the sustained gains over the last 20 days, the pressure to take profit is diminished, as opposed to short-lived volatile spikes. Silver price will likely retain upward momentum as long as it stays above the pivot level. Now we'll show you the best clips of the latest interview, but first, smash the subscribe button, hit the like button, and turn on notifications so you do not miss out our daily recaps.
So in the year 2000, we had a stock market bubble concentrated in the Nasdaq. We didn't have a bubble in the S&P 500. A bubble really concentrated in Nasdaq stocks. And that burst, and that caused a recession, and the Nasdaq dropped 80%. But it was just a Nasdaq bubble, wasn't it? It wasn't even a stock, wasn't a credit bubble, wasn't a stock market bubble, and wasn't a housing bubble for sure. And then in 2006, we had a housing market bubble. We didn't have a stock bubble, and we didn't have a credit bubble really. It was a stock market. It was a housing market bubble. But today we have a credit bubble, we have an equity bubble, and we have a real estate bubble, all existing concurrently and at record proportions. That just cannot end well. Now, the only thing I think that could save us, and I'm not even sure it could save us right now, because let me just tell you what I think could save us. I think if the Fed went below the rate of inflation, so if the Fed were to slash interest rates right now below 3%, so right now we're at 5.25 to 5.33. So you're talking about 200 plus basis points in rate cuts immediately. That might work, but here's the problem. If they did that now, I think the long end of the bond market, so if they did that, ex ante, so before we had a recession, then you would see, I believe you'd see the long end of the bond market go, it would crash and yields would spike. There's a very good reason for that, because you'd have all of the fears of inflation coming back from a very aggressive Fed on top of the fact that we already have an insolvent nation with $2 trillion deficits in a context of near record low unemployment. So, I don't think in other words, I'm not a Cassandra. I have a portfolio. The portfolio is up this year, doing just fine, thank you. I'm not sitting there shorting stocks all the time. That's not how I make money. I make money by making my clients money, so I don't spread fear. But I'm monitoring the situation here. I just laid out the situation. The situation is a very unbalanced economy. It's been marred by inflation. We have 3 big asset bubbles existing concurrently. We have an insolvent nation of assets minus liabilities. All those things are facts. I am monitoring the model that I created, which can Part of the model contains financial conditions and credit spreads. And when those internal components, those arcane internal components, start to signal that we've got a problem, then I will adjust the portfolio to be more bearish, more hedges. But right now, we continue. We have some hedges. We do have some gold. I have a couple of I'm in bond and bond proxies, which are doing very well in this disinflation, not deflation, disinflationary environment. We've been long India for a very long time. It's been a great trade for us. But getting the timing correct, if I am right about the bubbles bursting, you need that model. You need to monitor those arcane internal components, and that's exactly what we're going to do.
What do you think of Pento's take? Is he correct? Do you think gold and silver prices will rise in turbulent markets? Share in the comments section your honest opinions. Subscribe if you have not yet done so. And check this video right here because you'll like it. I'll see you on the other side.